Jeff, and what do you make of the fact that the auto market is actually strong, as you explain, yet they're getting no ramp up on the EV side, and even losing numbers they had been doing last year. It's isn't that astonishing? I mean, after all these promises and all these PowerPoint presentations to whoever wanted to listen to them, that they can't get their act together.
Yeah, they have a decision they have to make because right now they still have pent up demand on the combustion engine cars from the prior 2 years of really supply chain, misexecution. Tesla had parts. Tesla was able to scale their production even through the pandemic, and even Toyota in the last quarter was calling out, issues with chip shortages. So I think they're still kind of burning through some pent up demand. People wanted to buy cars over the last couple of years and they couldn't. But you have to ask yourself at some point that does level out. And normally the U.S. auto market is 15, 16, 17 million units. So this is pretty strong. But what they're doing is they're, I mean, if you look at the gross margin picture, I mean, GM hasn't broken out EV gross margin. We know it's terrible. And we know both GM and Ford actually under delivered in Q2 versus what they guided for. Rivian is showing relative strength, but even Rivian's, their last data point, I think there was at minus 80% gross margin. So they've got some work to do to get to break even. But yeah, it's going to be difficult to scale in this high interest rate environment to put out new capital in a way that are you going to accelerate as an EV manufacturer, it's a legacy manufacturer? Are you going to accelerate capital expenditure and ramp up labor and hiring to produce cars that bring back negative gross margins? And the answer to that in this environment is no. This isn't 2 or 3 years ago. So they're in a real pickle. And I hope the analyst community wakes up. I know the last Ford call, they really started drilling them on EV and like, what's going on? You said this would be a lot better. And one final point is, if you look at the days of inventory of legacy auto manufacturers and you look at EV versus non-EV, their EV numbers are almost double their non-EV cars, which means they actually have supply in many situations, but they actually don't have the right product and the right that consumers want to buy. They're buying Model Ys.
And had a couple of fleet deals. I remember the Domino's deal with the Bolts, right? 800 or 1,000. I don't remember exactly the number. So given all the small good news that came in, the results are just disaster. They're not catching up. Tesla's market share is increasing. Adoption rates are increasing. I hear you that they have to survive, and to survive, their strategy makes sense, but it's so short-sighted.
Well, let me add it. Yeah. Sorry, Jeff. Go ahead. Sorry.
Please. No, please go ahead.
Oh, okay. So, John, do you mind throwing up that chart again with the Model Y, Model 3, the Chevy Bolt with the bars?
Yeah. So let me find it.
Yeah. So here's sort of encapsulates what the problem is, and this is, I think, a trend into the next decade, and why legacy is such a big trouble, and this is an early signal. So the Chevy Bolt, which is the third one, is a $28,000 car, $27,000 car, discontinued this year. So they will stop shipping it at the end of this quarter. So basically, this is the list that we're working with, okay? Tesla Model Y, newcomer, first place. Tesla Model 3, newcomer, second place. Remove the Chevy Bolt. What's in third place? A $90,000 pickup truck from a newcomer, right? So the top 3 spots in the United States are all newcomer automakers, right? And then what's after the Rivian R1T, the Volkswagen ID4, which averages around 35 to 40,000 after an EV tax credit, and then after the Ford Mustang Mach-E. So the signal that I see here from this data set is that even in an environment where automakers have competing products for electric vehicles, the legacy automakers are not selling nearly as much as they should because of either consumers don't think their product is good, or the automakers are not offering something that is a good value for money, right? So like the Ford Mustang Mach-E is a perfect example. I actually think it's a good car, but it's way too expensive when you have a Tesla Model Y in the play, like out there being sold, and that car is getting half the credit than the Model Y because of how they've sourced the materials because of the EV tax
Exactly.
credit, right?
The Tesla price cuts killed them. I mean,
Killed them.
this shows it. This shows exactly the effect of the last 6 months of price cuts.
You look at the Model X; it's essentially double the MSRP of a Mach-E, and it almost eclipsed it. Yeah, I mean, you're right. I mean, Farzad, when customers want a truck, they're buying a Rivian. I mean, that's what the data says. And when they want a sedan, they're buying a Tesla. The Hyundai Ioniq Q, I think, is getting good reviews, but it doesn't get the IRA credit. And this is, this is a year where customers go in, buy a car, and if they qualify for the IRA credit, they get it on a tax return maybe next May or June of next year. They drive off the lot and they have a year basically of they have the high car payment. They don't have that 7,500 in, but come January, they're going to drive off the lot with the 7,500 in their pocket. And so that's what I'm saying. The EVs have had EVs. I don't think there's going to be an EV recession. I'll just call it here. I don't think there's going to be an EV recession. There's just going to be continued migration from ICE to EV.
Yeah, actually, I never thought of it like that. That's crazy. Just thinking like, really ultimately, it's not going to be a demand issue. It's just literally going to be taking sales away from the ICE cars, which, Elon has always said that the competition is the ICE car, not necessarily like the EQS or the Mustang Mach-E. But yeah, it's just pretty radical when you look at this chart and you think of the major competitors, and really there's tens of other car brands like the EQS, the BMW like the iX4, like all of those other additional brands that aren't even making this list, that are still slowly ramping. But at the end of the day, it's just when you look at buying a Mustang Mach-E versus the Model Y, even still now, even in 2024, you're looking at potentially a product that has superior or inferior software. The charging network will not be completely up and running until, again, a year from now or early 2024. And so and the price is, a lot more. So it's just more of like the incentives to buy a Mustang Mach-E, and even some of these the Volkswagen ID4 and some of the other options out there. Again, the Chevy Bolt is going away. It just makes more and more sense. And at some point, the Toyota Corolla has held the crown. I mean, I remember growing up, the Toyota Corolla was just the car that you go buy, the Honda Civic, just because it was so reliable. And the Model Y is essentially becoming that. It's just going to become one of those things. And people are going to get to a point where they're just like, you know what? I don't want the thing that everybody else has, even though it's literally the best car, the best option for you to go and buy, right?
And what's even more interesting, so piggybacking what you're saying, and Jeff, what you mentioned earlier, that if somebody wants to buy an EV sedan, they buy a Model 3. If they want an EV pickup, they buy a pickup truck. But then think about the gas car market and what it looks like right now. So every single segment has a gas car, but which ones are the ones that are truly profitable, especially in an environment where EV is going to be pulling share from gas car? It's really just the pickup truck and maybe the SUV. So if you fast forward about 3 to 5 years, as EVs continue to grow, and who are the players that can manufacture EVs profitably that are not pickup trucks and not SUVs? It's really only Tesla. And if you think about what is the true benefit of an electric vehicle long term, is the cost per mile equation, is that it's a cheaper car to own. And so if you're an automaker that can build a cheap car to own profitably, you win. So what I think is going to happen in the next 3 to 5 years is that the electric vehicle, if you want to buy a sedan or say an SUV or a compact car, the only one you're going to be able to buy is going to be electric, because the gas car one doesn't make a profit. Sedans don't really make a profit for automakers. Compact cars definitely don't make a profit for automakers, right? And so this is how the auto segment should evolve through this decade. So we'll still have gas pickup trucks as Rivian and Tesla and Ford and whoever else ramp up their EV pickup trucks. But I expect the Corolla at some point to be discontinued. I expect the sedans to be discontinued in favor of those electric vehicle models. And you could have these legacy automakers that are going to, in order to survive the decade, they're going to have to massively cut the type of segments and products they push to their lines to remove that complexity, kind of like what Ford did. So the Ford model is going to be adopted by other legacy makers, I expect. So that's the kind of, I think, landscape we're gonna be in. I don't know if you guys agree with that or not, but that's what it's looking like based on this data.
Yeah,
Couple of
it
tough
definitely
years
feels that
ahead,
way.
right? Yeah.
Yeah, I was just going to make one other quick comment if you're able to pop that chart up again and just put yourself in the chair of kind of the head of sourcing or supply chain for Tesla, and you're walking into a supplier meeting. Let's say you're Steel Dynamics or whomever, and you walk in with charts like this, and you put them down on the table, and it's not to brag, it's just to say, look, we told you, here's our demand. So you come in with your own internal charts of like, hey, we gave you this demand signal a year ago, and look at this is what we're actually doing. And oh, by the way, when you put a chart up like this, you're actually showing what the competition is doing, which is not a whole lot. And you use this information. They've got great information and great leverage with their supply base. I think Amy brought up the point earlier about Model Y, becoming the number one selling car. I think sometimes if you think about it purely from a supply chain perspective, that's a very powerful thing, because sometimes people look at Toyota volumes or GM volumes and they're like, wow, they're shipping millions of cars, but they're shipping, and Alexander brought this point, where they're shipping it over like 25, 30, 50, 100 SKUs. So the run rate at those suppliers per SKU is actually a very small number. Whereas if they get a Tesla part award, they're going to get, for this year, they're going to get if you're sole sourced on Model Y, you're going to get a 1.3 million unit award this year. That's going to stretch into the following year, and it's going to grow to 2 million potentially, or maybe 1.8 to 2 million. And that's the most powerful auto award you can get in the industry. And I don't think people realize that the leverage that they have over their supply base just on their current portfolio, and then they flash up their future portfolio, which is very public, Gen 3 models, Cybertruck, and so forth. You'd be very excited. Now walk into that same meeting in your GM or your Ford, and you've got this big legacy business, but you've actually misled a lot of your supply base in terms of what you're going to do in EV. You've told them things over the last 5 years that haven't materialized. Those suppliers capitalized for you. They hired people. They set up an operation, and you're not shipping the volume. And I guarantee you, they're not taking the parts from those suppliers or telling them to hold them. So it's the tale of two tapes, and I think it's very powerful for folks to understand of like where this could go from a COGS perspective for Tesla. I believe there will be an acceleration in COGS reduction that will surprise many analysts that really don't do a good job of actually doing the supply side and COGS side analysis, in my opinion, and probably could improve in that area.